talk about another company now, L&T Finance. This was a good quarter for the company. NII, profits and asset quality have improved. So let's get a lowdown on what's happening. N. Sivaraman, the President and whole-time Director of L&T Finance, joins us now to talk about that. Mr. Sivaraman, good morning, and it's always good to have you on our show because not just about your own company, but we get a sense of what's happening with the various industries that you lend to as well. This quarter, the standout improvement has come in your asset quality, where your gross NPAs have reduced to 2.2%. Tell us, within the, among the segments that you lend to, whether it's tractors, two-wheelers, or even road projects, where are you seeing lesser number of bad assets this quarter?
The retail book typically performs in a very seasonal way, which means that June and December quarter, as the GNPAs do pick up because of the general way the economic activity of this segment happens. The September and March quarter, we do see a reduction, and March especially with the Kharif crop getting harvested. The level of cash inflows with our client segments are also very strong, so they typically come down. In the retail segment, we have seen a reduction in the farm book. We have seen a reduction in the CVCE book, but a lot of it is driven by our own exposure to the segment being dramatically lower compared to the past years. We have also seen some of the SME accounts which were in NPA have got upgraded thanks to their consistent payment performance over the last 18 to 24 months. In the wholesale segment, our stress levels are more around the construction companies and some of the vendors to public sector companies. That situation has not dramatically changed over the last, say, 2 to 3 years. They continue to remain stressed, and they are not seeing significant improvement because the economic activity in the country has also been low for the last 3 years. And in the first 3 months or in the next 2 quarters, we do not see this really picking up unless the order flows from the government sector, basically NHI and the thermal power, whatever is left out in terms of completion, this really picks up. Without this, we don't see this sector really dramatically changing. Our project sector assets which are restructured there are largely technical restructuring because of delay in commercial operation day. We don't see a stress really increasing on this segment. Our general overdue levels have been stable to coming down. We are not seeing any big new slippages, new stress emerging on our balance sheet. So as I look at the current year, while there could be seasonal variation of gross non-performing assets in the retail segment between over the year, but overall we would tend to see improvement in terms of the ratio of GNPA to overall assets. That's something which will happen. As far as the wholesale segment is concerned, the movement could be within the stress segment of restructured assets and the NPAs rather than any new slippages into restructuring. One cannot say with a level of confidence that it may not happen. But as we look at the portfolio today, we feel far more confident, and we perhaps have seen the worst of the crisis so far. From here onward, there should be improvement. The wholesale segment improvement can happen more gradually because these are stickier in terms of resolution abilities. Whereas the retail will be subject to the seasonal fluctuations. We should see an improvement in ratios.
Okay, so, for the combined gross NPAs, which currently stand at 2.25%, sir, do you think, it will improve? What would you target by the end of FY15, FY16, that's March of 2016? How much could it come down to?
So, the ratio improvement can come from 3 sources. One is, of course, the absolute improvement in the GNPA levels. But with the increase in book, this that may or may not be possible. The ratio will also be a function of the denominator, how is the asset growth, how strong it is. That will also drive us. We do see a decent growth in the assets for the current year. So that itself will also bring down the NPA ratios. The third is in terms of our provisioning write-offs that happens on a consistent basis will also help us. Overall, I think we can see a stable to improving asset quality. I may not want to put a number to it. Generally, on an overall basis, it will remain stable to improving.
Can you throw some more color on this point you made about the reduction in the farm book and the CV book delinquencies? Because, for the farm sector, we still don't have access to how much the damage could be because of the unseasonal rains. And in the commercial vehicle sector as well, it's been just 4 or 5 months of a rebound. So do you think that the stress in these sectors could alleviate in the quarters to come?
It would, yes. From the overall level, if you look at it, it depends on the exposure to the various geographies that you have, and whether harvest was largely done or not done, and what kind of crop it is. As compared, you all will realize that as compared to fear about the damage to the wheat crop, there has been far less than what it was feared to be. The wheat prices have also remained stable to improving, so this definitely helps the farmers. As far as the current quarter is concerned, it's going to be a function of a few things. One is, of course, how much of the damaged crops have since been harvested in this quarter and then been able to realize value for it. Second will be the effect of monsoon and the way how people will prepare or the outlook towards monsoon. So I would guess that sector areas which are well irrigated may see lower stress, whereas those which are depending on the rains will have increased stress. Our exposure largely has been around areas which are irrigated. So hopefully, other than the seasonal fluctuation, we should be in a level of say comfort, even though the level of stress could marginally increase.
If there is a rate cut in the June policy, say 25 basis points, and maybe we do not get even another one till the end of the calendar year, what's your expectations in the net interest margins? Do you see it improving? Walk us through how you see your borrowing costs in FY16.
Our outlook is that the borrowing cost should taper down, but may not be very significant, because if you look at the bond market, they have already come down quite dramatically over the last full year, and today with the volatility in the government securities price, they have shown some volatility also. But given the gap between the bank lending rate and the bond market rates, I don't see a very large opportunity for reduction in the borrowing cost. We have also brought down the proportion of bank borrowings to close to around 40% at the overall level. So to that extent, if the banks do go ahead and reduce rates, they will see some benefit. The bond prices itself, I am a little uncertain, because there is the issue of US rate reversals, rate increases, which have resulted in a level of outflow in the foreign inflows, or even the renewals of existing investments have not happened. So at the liquidity level, you may not find an opportunity of the bond prices improving significantly from where they are today. So all in all, I'll say that there will be some improvement, but it will not be very significant like what we experienced in the last year.
Okay. You've repeatedly been saying that you're looking out for any kind of inorganic acquisitions. We've all been reading and hearing about talks of L&T Finance being interested in Yes Bank. Is there any truth to that? And can we hear anything about inorganic acquisitions in the months to come?
One is an inclination or wanting to look at inorganic way to grow. The second is opportunity on the table. As of now, we have nothing on the table.
All right, Mr. Sivaraman, unfortunately, we've run out of time, so there is a lot to discuss with you. But thanks so much for taking the time out and joining us today.